Let me ask you something. When was the last time you saw hedge fund managers, institutional investors, and Wall Street analysts all panicking at the same time? And for the same reason. Because right now, that's exactly what's happening. And if you've been watching the news, you probably think you already know why. Oil prices, right? Maybe the Federal Reserve. Maybe some geopolitical tension somewhere. But here's the thing. You'd be wrong. The real reason Wall Street is losing sleep right now has nothing to do with any of that. And by the time this video is over, you're going to understand something that most retail investors won't figure out until it's already too late. So stay with me, because this one genuinely matters for your money. Now, before we get into the meat of this, I want to paint you a picture. Imagine you're running $1 trillion fund. You've got analysts, economists, risk managers, the best minds money can buy. And for the past decade, your entire strategy has been built on one fundamental assumption, a bedrock belief that has guided every single investment decision you've made. And then, almost overnight, that assumption starts to crack. Not shatter, crack. Just enough to make you question everything. That's the situation Wall Street finds itself in right now. And the crack I'm talking about? It's in the bond market. Specifically, it's in the long-held belief that U.S. Treasury bonds are the ultimate safe haven asset on planet Earth. Let that sink in for a second. For literally decades, we're talking since the post-World War II era, the U.S. Treasury market has been the backbone of global finance. When stock markets crash, money flows into treasuries. When economies slow down, investors run to treasuries. When geopolitical crises erupt, where does the smart money go? Treasuries. It has been the most reliable financial safe harbor in the history of modern capitalism. And right now, for the first time in a very long time, sophisticated investors are starting to ask whether that's still true. And that question, just the asking of it, is enough to send shockwaves through every corner of the financial world. Here's why this is such a big deal. The Treasury market doesn't just affect bond investors, it affects everything. Mortgage rates, corporate borrowing costs, stock valuations, pension funds, insurance companies, foreign governments, they all tie back to U.S. Treasuries in one way or another. The 10-year Treasury yield is essentially the price of money in the global economy. When that price behaves in unexpected ways, every financial model on Wall Street starts spitting out numbers that don't make sense. And that's exactly what's been happening. Now let me explain what's actually going on under the surface, because the headlines are not telling you the full story. Over the past couple of years, something unusual has been happening in the bond market. Yields on long-term U.S. government bonds have been climbing and staying elevated, even in periods where you would normally expect them to fall. Think about that for a moment. Traditionally, when there's uncertainty in the markets, when investors are nervous, they buy treasuries, which pushes prices up and yields down. That's how it's supposed to work. But lately, that relationship has been breaking down. Yields are staying stubbornly high, even when the economic data gets shaky, and for Wall Street, that is a massive red flag. There are a few things driving this, and I want to walk you through each one, because understanding this will genuinely change how you think about investing. The first factor is what economists call the term premium. This is basically the extra return that investors demand for tying up their money in a long-term bond, rather than rolling over short-term ones. For a long time, years actually, the term premium was essentially zero, or even negative. Investors were so desperate to hold treasuries that they didn't even ask for extra compensation for the risk. But now, that term premium is rising. Investors are starting to demand more return for holding long-term government debt. And why? Because they're becoming less certain that inflation will stay under control, less certain about the long-term fiscal path of the United States, and yes, less certain that the dollar will maintain its dominance in global trade. That brings me to the second factor, and this one is probably the most significant long-term shift happening right now. For decades, the US dollar has been the world's reserve currency. That means central banks around the world hold dollars, and by extension, US Treasuries, as their primary reserves. This created this incredible, self-reinforcing cycle. The US could borrow essentially unlimited amounts of money at low interest rates because there was always a massive captive audience of foreign buyers. China, Japan, Saudi Arabia, the European central banks. They all needed dollars, and they parked those dollars in treasuries. It was the perfect system for the United States. But here's what Wall Street is quietly freaking out about. That captive buyer base is shrinking, not collapsing. Shrinking. China has been steadily reducing its treasury holdings over the past several years. Other countries have been diversifying their reserves into gold, into other currencies, into alternative assets. The BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding coalition, have been openly discussing ways to conduct international trade without using dollars. Now, I'm not saying the dollar is about to lose its reserve currency status tomorrow. That's not going to happen overnight. But even a gradual, slow-moving shift in that direction has enormous implications for Treasury demand. And less demand for Treasuries means higher yields. Higher yields mean higher borrowing costs for the U.S. government. And higher borrowing costs for the government mean higher borrowing costs for everyone, including you with your mortgage, your car loan, your business. The third factor is the one that Wall Street really doesn't want to talk about publicly, but everyone is whispering about in private. And that's the U.S. debt trajectory. The national debt has now crossed $36 trillion. The United States is spending somewhere in the range of $1 trillion a year just on interest payments. Let that number sit with you. $1 trillion a year. Not on defense, not on healthcare, not on infrastructure. Just on the interest on existing debt. And with yields now significantly higher than they were just a few years ago, that interest burden is only going to grow as older, cheaper debt matures and gets refinanced at today's higher rates. This is not a partisan political point. It's arithmetic. And Wall Street's best mathematical minds are running those numbers and not liking what they see. Now here's where this connects directly to your portfolio and why this matters for everyday investors. For the past 40 years, since roughly the early 1980s, there's been an investment strategy that has worked beautifully. It's called the 60-40 portfolio. 60% stocks, 40% bonds. The idea was simple. When stocks go down, bonds go up, and the two balance each other out. It was the cornerstone of retirement planning, of institutional portfolio management, of basically everything. And it worked magnificently for 4 decades because bonds, especially treasuries, reliably went up when stocks went down. But in 2022, for the first time in modern financial history, stocks and bonds crashed at the same time. Both fell. The hedge didn't work. And now Wall Street is grappling with a genuinely disturbing possibility. What if that wasn't a one-time anomaly? What if the relationship between stocks and bonds has fundamentally changed? If it has, then the entire framework that professional money managers have used for a generation needs to be rebuilt from scratch. And rebuilding that framework means moving money, a lot of money, which creates volatility and opportunity in equal measure. So what does all of this actually mean for you? What should you be thinking about right now? The first thing I'd say is this. Diversification has to mean something different going forward. If both your stocks and your bonds can fall at the same time, then bonds are no longer providing the protection you thought they were. That doesn't mean you dump all your bonds. It means you need to think more carefully about what real diversification looks like. Some investors are looking at commodities, at infrastructure, at real assets, at international diversification across different currency zones. Gold has been making a quiet comeback as a genuine reserve asset for a reason. Even central banks have been buying it at record levels. The second thing is to pay close attention to duration risk in your fixed income holdings. Duration is a measure of how sensitive a bond is to interest rate changes. Long duration bonds, like 20 or 30-year treasuries, get hit hardest when yields rise. If you're holding long-duration bond funds in your portfolio, you may be carrying more risk than you realize. Shorter duration instruments, floating rate bonds, inflation-protected securities, these are worth understanding right now. The third thing, and this is maybe the most important mindset shift, is to stop assuming that what worked in the last bull market will work in the next one. The conditions that drove markets from 2010 to 2020, near zero interest rates, low inflation, massive central bank support, and insatiable foreign demand for U.S. assets. Those conditions are gone. The game has changed. And the investors who recognize that early, who adapt their thinking rather than clinging to old playbooks, are the ones who are going to come out ahead. Now, I want to be crystal clear about one thing, because I don't want to leave you feeling panicked or despairing. Panic is not the appropriate response here. The investors who panic and make emotional decisions are the ones who get hurt. What I'm describing is a shift, a significant, multi-year structural shift in financial markets. And shifts create opportunities just as surely as they create risks. There will be sectors that benefit from higher rates. There will be asset classes that perform well in a world with more inflation uncertainty. There will be companies with strong balance sheets and real pricing power that thrive in this environment. The opportunity is absolutely there, but you have to be paying attention. You have to be thinking clearly, and you have to be willing to question the assumptions that may have served you well in the past. Wall Street is panicking because its assumptions are being challenged. The smart move for you is not to panic alongside them. It's to understand why they're panicking, learn from it, and position yourself accordingly. The bond market is telling us something important right now. The question is whether you're listening. If you found this valuable, hit the like button. It genuinely helps this kind of content reach more people who need to hear it. Subscribe if you haven't already, because we go deep on these macro trends every single week. And drop a comment below. I want to know what you think about this shift in the bond market and how you're positioning your portfolio. I read every single one. I'll see you in the next one.